So, imagine sitting at your desk, right? You open up a standard manila envelope and you realize that your 2026 insurance renewal just completely wiped out your entire profit margin for the year.
Oh, yeah. A total gut punch.
Exactly. Your general liability is up 10%. Your umbrella policy is up like 30%. And excess liability. I mean, you're lucky if you can even find a carrier willing to write it at all right now.
Right. It's basically a ghost town out there for excess.
Yeah. So if you're a construction business owner listening to this deep dive right now, you already know this is no longer just, an annoying line item on a spreadsheet.
No, not at all.
This is an existential business survival issue. It's like having a silent partner who just takes an ever-growing cut of your profits month after month, but they don't pick up a single hammer, they don't review a single submittal, or pour a single yard of concrete.
I love that. That silent partner analogy really hits the nail on the head. Because unlike a real business partner, the insurance market right now, they don't share in your downside risk. They're simply taxing your revenue.
Right. Just taking their cut off the top.
Exactly. And when you move from the shock of opening that renewal envelope to looking at the broader industry landscape, it becomes clear really fast that this isn't a localized issue.
It's not just one bad broker.
Right. Or a penalty for one unlucky contractor. We're looking at a systemic, nationwide structural shift in how risk is actually priced.
See, I want to challenge the premise of this being systemic, though, because, construction is booming right now, isn't it?
It is, yeah. Very busy.
There's federal infrastructure money flowing literally everywhere. Cities are expanding, and contractors have these huge backlogs stretching into, 2027 at this point?
Easily 2027, yeah.
Right. So if the industry is essentially printing money and staying consistently busy, why is the risk suddenly so toxic to underwriters? Why the sudden squeeze?
Well, because the squeeze isn't correlated with construction volume at all. It's actually correlated with legal outcomes.
Okay. The lawsuits.
Yep. But before we get to the courtroom stuff, we need to look at the raw renewal numbers just to understand the sheer scale of the panic right now.
Let's hear them.
So the February 2026 Ivans Index, they tracked general liability renewal rates climbing at a positive 7.01% month over month.
Wow. Over 7%.
Month over month. And get this, general liability and workers' comp are the only commercial insurance lines increasing right now across the entire, broader economy.
Wait, really? The only ones?
The only ones. Construction is completely isolated here. You guys are bearing the brunt of a uniquely targeted rate hike.
Man, and that isolated squeeze, it's even more pronounced when you break it down by policy type, right?
Yeah.
Willis Towers Watson just released their 2026 numbers, and they are incredibly grim.
Oh, they're brutal.
Yeah. They track general liability as flat to up 10%. Auto liability is up 8 to 20%.
Which is huge for anyone with a fleet.
Exactly. Builder's risk is sitting flat to up 10%, specifically on high hazard projects. And then umbrella policies jumping 5 to 30%.
Yeah, and then you look at the excess liability layer that's taking an unprecedented jump of 7 to 40%.
40%? When a contractor stacks those percentage increases across an entire corporate portfolio, you're looking at hundreds of thousands, sometimes millions of dollars just vanishing directly from the bottom line.
Poof, gone. And the pain isn't distributed evenly across the industry either.
What do you mean?
Well, Smart Business Automator's market intelligence report indicates the hardest hit categories are street and road work, demolition, scaffolding, and really any work involving heights.
Okay, so the high-risk physical trades.
Right. And geographically, Pennsylvania, New York, California, and Texas are the hardest hit states.
Always the usual suspects with the regulations.
Yeah, but underwriters are zeroing in on these specific trades and regions, mostly because they are the epicenters of that legal phenomenon I mentioned earlier.
Right. The legal stuff. You're talking about the nuclear verdict, aren't you?
Wham.
I hear that phrase thrown around at industry conferences all the time.
Yeah.
Nuclear verdict. But what is the actual threshold for a judgment to be classified as nuclear?
Yeah.
And what's the underlying mechanism driving them?
So the industry defines a nuclear verdict as basically any jury award exceeding $10 million.
$10 million. Okay.
Yeah. And 2025 went down as one of the worst years on record for these massive payouts.
Why? What changed?
Well, the mechanism driving this is a mix of psychology and evolving legal strategies.
Yeah.
Think about it. When a severe accident happens on a job site, say, a scaffolding collapse, juries are naturally and understandably highly sympathetic to an injured worker.
Sure. or their grieving family. That makes total sense.
Exactly. But simultaneously, there's this pervasive cultural hostility toward large corporations right now.
Ah, right. The corporate greed angle.
You nailed it. A plaintiff's attorney, they don't just argue for lost wages anymore. They argue that the contractor actively prioritized corporate greed over human life.
Wow. So they paint you as the villain.
Precisely.
Yeah.
And because of that specific narrative, a single wrongful death case that might have settled for, say, $2 million a decade ago, it's now generating a $25 million verdict.
Which instantly wipes out the contractor's primary insurance.
Completely. And it entirely exhausts their excess layers, too.
But it seems like there's more than just, organic jury sympathy driving this trend. There's a very deliberate financial engine behind these massive lawsuits, isn't there?
There absolutely is. The insurance industry calls it social inflation.
Social inflation.
Yeah, and the primary engine behind it is litigation funding.
Okay, break that down for me.
Basically, private investment firms, essentially private equity, they're actively bankrolling plaintiff attorneys.
Wait, private equity is funding injury lawsuits?
Yes. They provide the millions of dollars in capital required to pursue these massive, drawn-out lawsuits against construction companies.
That is insane.
It is. They hire the best expert witnesses, they fund exhaustive discovery processes, and they straight up refuse early settlement offers.
Because they can afford to wait.
Right. And in exchange for fronting all that money, the investment firm takes a percentage of the final verdict.
So it's essentially Wall Street investors short-selling construction safety.
Oh, that's exactly what it is.
I mean, they are literally turning another company's worst day, a tragic job site accident, into a highly capitalized, speculative investment vehicle for their own portfolios.
Right.
They need the $25 million nuclear verdict to deliver the expected ROI to their own investors.
You've got it perfectly. They are monetizing the contractor's liability. And because these lawsuits are fully funded, the plaintiff's attorneys have absolutely zero financial pressure to settle early.
They just drag it out.
They drag the contractor's insurance company through years of litigation until the insurer finally just panics and pays out the policy maximum just to stop the bleeding.
Which is why the premiums are skyrocketing.
Exactly, because underwriters know this. Because a $25 million verdict is now a statistical probability rather than a freak outlier, the physical structure of how insurance policies are issued to mid-sized contractors is basically collapsing.
Okay, let's break down the mechanics of that collapse. How does an underwriter's fear of a nuclear verdict actually change the piece of paper the contractor signs?
Well, it changes the fundamental architecture of the umbrella policy itself.
How so?
So 5 years ago, a mid-sized contractor bidding on, say, a heavy civil project could just go buy a single $25 million umbrella policy from one carrier. Done.
Nice and simple.
Very simple. But today, insurers are terrified of being on the hook for that entire amount if a nuclear verdict hits.
Right.
So they are strictly capping their lead layers at $10 million per risk.
Okay, so if a project requires $25 million in coverage, the contractor has to build a tower.
Yes, exactly, a tower.
Meaning they have to stack multiple carriers. Like carrier A takes the first 10 million, carrier B takes the next 10 million, carrier C takes the last 5 million.
Right. And building that tower introduces massive friction into the business.
I can imagine.
Because every time you add a new layer, you pay a new premium markup. Each individual carrier has to conduct their own risk assessment.
So you're paying for 3 underwriting processes instead of 1.
Yep. And worse, you introduce dangerous coverage gaps.
How does that happen?
Well, say the policy terms of carrier A might exclude a specific type of soil subsidence, right?
Okay.
But carrier B includes it. If an accident falls into that gap, the entire tower collapses and the contractor is left holding the bag.
Oh, man. Which directly impacts their balance sheet, bringing us to the collateral damage of this whole insurance crisis. Because this isn't just about paying more for premiums, is it?
No, it's not.
This triggers what the industry calls the insurance to bonding death spiral.
Yeah, the death spiral. The bonding aspect is where this goes from a simple profitability issue to an outright survival issue.
Right.
Surety companies are watching these nuclear verdicts just as closely as the liability carriers are.
Sure, they have to.
And Smart Business Automator's market intelligence report reveals that surety loss ratios actually skyrocketed from 16.5% in 2022 to 26.4% in 2024.
That is a massive jump.
It's huge. And because of that massive jump in losses, surety underwriters are heavily scrutinizing labor, schedules, and specifically the working capital of the contractors they bond.
So walk me through the actual math of that death spiral. How does a premium hike on a Friday afternoon translate into a slashed bonding capacity by Monday morning?
Okay, it comes down to how a surety calculates your bond program. They look at your working capital, which is, your current assets minus your current liabilities, and they usually apply a multiplier.
Like what kind of multiplier?
Say 10 times your working capital. That determines your total bonding capacity.
Got it.
So if your general liability and umbrella premiums suddenly jump by $400,000, you have to write that check.
You don't really have a choice.
Right. That cash leaves your balance sheet immediately. So your working capital just shrank by $400,000.
And because of the multiplier, that $400,000 cash hit doesn't just reduce your bonding capacity by $400,000. It reduces it by $4 million.
Exactly. Your surety capacity shrinks overnight.
Wow.
And now, with a lower bonding capacity, you can no longer bid on the $15 million municipal projects you used to win easily.
So you're boxed out of the big jobs.
You're forced to pass on the highly profitable, large-scale work and relegate yourself to bidding on, $3 million projects.
Which everyone else is bidding on too.
Right. Smaller projects inherently have tighter margins and far more competition. You are doing more work for less profit.
And because you are now operating on thinner margins, you have even less cash to absorb the next round of insurance premium hikes.
Exactly. You are starved of the revenue you need to pay for the insurance that allows you to work in the first place. That is the death spiral.
Man. So if a mid-sized contractor feels himself slipping into this death spiral right now, how do they hit the brakes?
It's tough.
Right, how do you pull out of a nosedive when the litigation funding environment and the surety underwriters are both actively working against you?
Well, to answer that, we have to look closely at some nuance in the current market. Because there is one area that looks like a financial lifeline, but it is actually a trapdoor.
Oh boy, a trapdoor.
Yeah, we need to talk about workers' compensation.
Wait, I'm confused. Earlier, you mentioned workers' comp as one of the only lines increasing alongside general liability. But on a national average, isn't workers' comp actually down slightly? I've seen reports showing it negative over the last few quarters.
You are correct about the national average. Overall, workers' comp renewal rates were down negative 1.43% as of February 2026.
Okay, so that's good news, right?
Well, contractors see that national average and think they finally have some relief to offset the massive umbrella hikes. But we have to look at California as the bellwether for where the entire industry is heading.
What's happening in California?
In September 2026, California is implementing new dual wage threshold increases that will hit 13 of 16 construction trades.
Okay, let's get into the mechanics of a dual wage threshold. How does that actually impact a contractor's payroll and insurance classification?
So in California, workers' comp rates are split based on hourly wages. If you pay your crew above a certain threshold, you get a much lower favorable workers' comp rate.
Because the state assumes higher paid workers are more skilled and less likely to get injured.
Exactly. But if you pay below that threshold, you get hit with a massively punitive high workers' comp rate.
Okay, I see where this is going.
Right. The trapdoor is that the state is drastically raising the threshold to qualify for the low rate.
Give me the hard numbers on those threshold jumps.
Okay, so for carpentry, the threshold to get the favorable rate is jumping from $41 an hour to $46 an hour.
That's a $5 jump.
Yep. Electrical is jumping from $36 to $40. Roofing goes from $31 to $33. So think about a contractor with a crew of carpenters making $44 an hour right now. Currently, they get the low workers' comp rate.
Right, because they were over 41.
But come September, if that contractor does not immediately give every single carpenter a $2 an hour raise to hit the new $46 threshold, the entire payroll for that crew gets reclassified into the punitive high-risk rate category.
Wow. So the business owner is forced into a brutal mathematical corner here.
Very brutal.
You either voluntarily hike your payroll overhead immediately, which obviously eats your margin, or you refuse the raises and take a massive punitive hit on your workers' comp premiums, which also eats your margin.
You are cornered. It's a lose-lose. And what happens in California historically rolls out to New York, Illinois, and eventually the rest of the country.
It always does.
Always. This is why simply crossing your fingers and hoping your broker finds a better rate is no longer a viable business strategy. Surviving 2026 requires aggressive operational tactics and top-tier financial leadership.
Okay, let's pivot to those tactics then. What are the highly optimized surviving contractors actually doing differently on a Tuesday morning to push back against this?
First thing, they are treating safety as a core financial metric, not just an HR requirement.
Making it about the money.
Absolutely. They are hiring dedicated risk managers, often on a part-time or fractional basis if they can't afford full-time. They are implementing formal, exhaustively documented safety programs.
With a specific goal in mind.
Yes. The singular immediate goal of these programs is to drive the company's experience modification rate, or EMR, below 0.85.
Why the intense focus on 0.85 specifically? Because, most contractors consider an EMR of 1.0 to be the industry average, right? 1.0 is average. But an EMR below 0.85 has quietly become the new de facto pre-qualification threshold for large general contractors.
Oh, really?
Yeah. See, an EMR is a trailing 3-year average of your safety claims. GCs use automated compliance software to screen subcontractors now.
So it's not even a human making the call. Exactly. If your EMR is 0.9, the top-tier GCs will automatically red flag you and won't even let you bid on their projects.
Because your perceived risk profile threatens the GC's own fragile insurance towers.
You got it. Safety literally dictates your access to revenue.
And so what about structural changes to how they actually buy the insurance? Are there specific purchasing tactics being used to bypass the standard market?
Yes, definitely. Savvy risk managers are completely abandoning piecemeal policy renewals.
Okay.
They are aggressively shopping the ENS, that's the excess and surplus lines market. They are actively bundling their general liability, auto, and umbrella coverage with a single carrier.
And putting it all in one basket.
Right, because if you can present a highly documented, unified, well-managed risk profile to one underwriter, you can often negotiate a 5 to 15% package discount.
Just by making their lives easier.
Simply by reducing the administrative friction of multiple carriers trying to assess your business independently, yeah.
But navigating the ENS market, calculating working capital for bonding, and analyzing the cost benefit of dual wage thresholds. That requires serious, high-level financial chops.
It's not for amateurs.
Right. A standard bookkeeper simply cannot manage this level of complexity.
They absolutely cannot. Which brings us to the DAXIT framework for CFOs.
Oh, tell me about that.
So the framework establishes a very clear rule of thumb. If your total insurance costs exceed 3% of your gross revenue, and that percentage is climbing year over year, bringing in high-level financial leadership is mandatory for survival.
Wait, just 3%?
Just 3%. And Smart Business Automator's Market Intelligence Report shows that contractors with dedicated finance leadership actually spend 22% less on insurance per dollar of revenue than those without.
22% less. That's massive.
The ROI of financial leadership is undeniable.
Think about a fractional CFO or a dedicated risk manager, like an industrial leak detection system on a massive plumbing project.
Okay, I like where you're going with this.
Right. Yes, they require significant capital to install up front. You have to pay their retainer.
Sure.
But they prevent the silent, invisible margin leaks, the redundant coverages, the misclassified payrolls, the shrinking bond capacities that will eventually flood the basement and sink the entire business.
That leak detection analogy perfectly isolates their value. However, there's a massive operational bottleneck we have to address here.
Which is?
We just talked about the demand for extreme documentation.
Right, the paper trails.
Underwriters, CFOs, and surety bond issuers all demand relentless auditable paper trails to prove a contractor is a safe bet. But in the physical reality of running a job site, demanding that level of paperwork creates total chaos.
Right. You tell a superintendent standing in the mud that he needs to spend 3 hours a day back in the truck tagging photos, cross-referencing engineering specs, and writing risk mitigation summaries, and he's going to roll his eyes, ignore the directive, or just quit.
He'll quit.
Right. So how do you actually scale these safety and documentation protocols without paralyzing the construction work itself?
Well, this is where the industry is being forced to adopt advanced administrative technology. You have to connect the financial demands of the underwriter to the operational reality of the job site.
Okay.
This is exactly what AI-powered platforms are built to do. They remove the bottleneck by taking the burden of proof off the human and putting it on the system.
Okay, I hear you on the AI, but construction has a graveyard of failed software implementation.
Oh, absolutely. Tons of them.
A superintendent is still going to resist if you just hand him another app with a steep learning curve. how does a platform actually change the operational reality instead of just shifting where the data entry bottleneck happens?
By entirely eliminating the manual data entry.
How?
Let's look at the mechanics of how a system like Smart Business Automator functions. It starts with smart document organization.
Okay.
The superintendent snaps a photo of a rebar installation. The AI automatically tags it, geolocates it, categorizes it by project price, and files it.
Without him doing anything else?
Nothing. It generates the daily log and meeting summaries by transcribing site conversations, keeping all stakeholders aligned without anyone typing a single paragraph.
So the underwriter gets their pristine daily log, and the superintendent gets to stay out of the trailer.
Win-win.
But what about the massive liability risks buried in the engineering drawings?
The platform uses document intelligence to extract vital specifications directly from complex, 300-page engineering drawings.
Wow.
It cross-references the specs against the daily field reports. It offers schedule risk detection by analyzing project velocity.
Meaning what?
Meaning it says, based on the daily concrete pours, you're going to miss your critical path milestone in 14 days.
So it spots the delay before it blows up the budget.
Exactly. It gives the CFO real-time budget and variance insights and provides highly detailed change order impact analysis.
So you are giving the CFO the exact mathematical dashboard they need to keep that insurance spend below the 3% DAXIT threshold we talked about.
Precisely. And the efficiency gains just compound over time.
How so?
Well, the AI project assistant allows natural language search across years of project data.
Oh, that's huge.
Right. If a lawsuit is filed 3 years after a project wraps, which happens all the time, you don't spend weeks digging through bankers' boxes in a storage unit.
Right.
You ask the AI to retrieve all RFI responses and photos related to the structural steel on that specific date. It runs automated compliance checking against project specs, and it utilizes custom API integrations to speak directly to the contractor's existing ERPs and accounting software.
So by automating all of this tedious administrative work, you are actively, continuously building the exact bulletproof paper trail that the insurance carriers are demanding to see.
Yes.
When it comes time to renew your umbrella policy, you aren't just telling the underwriter you have a culture of safety. You are handing them the mathematical, verified proof that your business is a heavily mitigated risk.
Exactly. You are fundamentally changing how they price your policy. You are transforming your company from a perceived liability into a highly attractive risk profile.
That makes total sense.
And, that leads me to a final, somewhat provocative thought to leave you with.
Lay it on me.
We've spent this entire discussion looking at the 2026 insurance crisis as a destructive force, right?
It is.
It is. But what if this severe squeeze is actually a forced evolutionary leap for the entire construction industry?
An evolutionary leap, like a mass extinction event that clears the way for a different kind of company.
Precisely. Think about the mechanics of a great fire. The companies that survive the next 5 years will not necessarily be the ones who swing hammers the fastest, or pour concrete the cheapest, or even have the most aggressive estimators.
Who will it be?
The survivors will be the contractors who master risk management, balance sheet optimization, and data operations.
Wow.
This insurance crisis is a filter that is wiping out the undisciplined operators. When the dust settles in a few years, the remaining highly optimized contractors are going to find themselves vastly more profitable, running incredibly tight ships, and facing significantly less competition than ever before.
The squeeze is incredibly painful right now, but it is forging a much more resilient, sophisticated industry on the other side.
That's the reality of it.
Well, if you take away nothing else from our conversation today, remember this. Insurance is the silent margin killer in construction right now. But it is not an uncontrollable force of nature, and you are not powerless against it.
Not at all.
If this deep dive saves you even 5% on your next renewal by prompting you to restructure your documentation, rethink your bonding capacity, or bring in high-level financial leadership, then it was absolutely worth your time.
100%.
But we need you to take action right now. Subscribe, rate, and review this deep dive from whatever platform you are listening on. Share it with your business partner, send it to your insurance broker, and email it directly to your accountant. And to see the exact technology that is actively solving this documentation crisis and building the paper trails underwriters demand, visit smartbusinessautomator.com.
Seriously, go check it out.
The next time you open that manila envelope and look at your renewal numbers, remember, you do not have to just accept what that silent partner is demanding. You have the tools, the data, and the strategies to fight back. Stay safe out there, and we will catch you on the next deep dive.